Well, thanks so much for tuning in to this conversation. We are at the Experience Center of Tata Communications and in conversation with Kabir Ahmed, the CFO of the company, to talk about how Q4 and how FY23 as a year has gone by, and how or what are the projections like, or how is the business landscape looking like for FY24 and beyond. Kabir, great having you. Thanks for having us. It's a wonderful experience center. The experience was truly amazing.
No, thanks for coming. Thanks for taking the time to come and experience this.
No, the pleasure was ours. It just helps. It helps me and my team at BQ understand this much better. Let's talk about the numbers first. Were you happy with the numbers? Were you a bit disappointed at the end of Q3 when the numbers came out and I spoke to you? You mentioned that don't look at it on a quarterly basis. Try and look at it on a slightly long basis. For Q4 as well, the revenue growth is almost flattish, and relative to Bloomberg estimates, even the bottom line numbers are a bit lower. So is it did you deliver what you set out to do, or could you have done more?
Actually, on the contrary, we are very happy with what we have delivered, Neeraj. This is 3 quarters of consecutive double-digit growth that we have delivered, and for the full year as a whole, a double-digit growth for the data business. So our data business, we have ended at over 10%, 11.2% for the quarter, which is what we set out to do 3 years ago when Lakshmi came into this, to this business, and we had our own set of challenges, internal and external, COVID and attrition and supply chain issues, and a lot of those things which was just eluding that growth. Now we firmly, have growth, under control. In terms of profitability, I've always set out that we are going to operate in the 23 to 25 range. And historically, I would say 2 years ago, we had a lot of COVID benefits. Nobody was coming to office. We were not traveling. There were not marketing events. Now it is BAU. It's all of those things have set back in. So all the COVID benefits that we had, and we had roughly estimated to be around 200 crores, a year. Those benefits are no longer there in the P&L because we are now back on track. On top of that, we are setting up the organization for growth. We've hired over 900 people in the last year.
Yeah.
And the salary tables, given the great attrition, have also have gone up. So all of these coupled with together is why our profitability and EBITDA impact got back-ended and got hit in Q4. But overall, for the year, we still delivered 24.2% EBITDA, which is well bang in the middle of the range, which is what we had all along informed the street as well.
Yeah, but correct me if I'm wrong, but I dial back to the last 3 quarterly releases, right? And when I look at the revenue growth versus the expenses growth, expenses have grown at a faster clip than the revenues have. Now, tell us a bit about why is this happening? Are you front-loading for execution at some point of time in FY24, 25 and beyond? What is going on there?
The large part of the increase is in staffing cost because we have 900 more, headcount in our organization, and these are, as you rightly said, an investment for the future. But before I talk that, Neeraj, I want to give a view of what the company's shape is today. Yeah. Compared to what it was 3 years ago.
I was actually going to come to that in a bit. I just thought we'll first talk about the numbers done and then kind of come to the shape as well.
Perfect. No worries. So then, just answering very narrowly, the question you asked, this is an investment, in people, and let me kind of draw a light on it as to what is that it comprises of.
Sure.
It comprises of largely 3 components, all of them customer facing, and I'm a fan. If a cost element does not face the customer or does not add value to the customer, it has no place in my P&L. I'm very, very categorical about it. So any investment that we will do will be customer facing and adding value to the customer. Even when it comes to staffing, there are 3 elements that I would, categorize them largely under. A bulk of it is towards my product and engineering organization who are creating the IP for the future. And we have an innovation program 1330, where one is today still at a desk and you're talking to one customer trying to co-create that solution. Then 3, figuratively it could be 3 or 5, but we just say 3, that you take to the next set of customers and see, does it have multiple use cases? Can it go to more industries? And once you get confidence, then you take it to 30, which is the productization, of that phase. So we have in our digital platforms and solutions space, a lot of these 1330s that are firing up. And that's where a bulk of the investment is going in IP creation. The second big investment is going in feet on street, right? Our sales organization, we are beefing them up, largely on international geographies. And we know they come at a dollar cost salaries than India, but that's the right thing to do because we are a global company, and India is an important market, home market for us, but at the same time we would like to be seen as a global Comtech player. And thirdly, where once we get the order book and we need to then implement those solutions to our customers. So the service delivery organization is a third element where we actually investing in all of them. Clearly, these should give me productivity and operating leverage. Now, will it be in FY24 or will it be in FY25? Depends on the product that they are working on, depends the market that you are in. And that is something which we will carefully track, as an organization, as a management, and then decide, do I need to, rev it up and add more, fuel to it? Or if it's not delivering the returns that we want, do I, then claw back? And I would like to then manage this very, very dynamically. Not doing investment will be irresponsible, and it will not then result in realizing the growth ambitions that this company has the potential to unlock.
Got it. But still, just probing that a little, would the OpLev be by design back-ended, or would you be hoping for it to come in FY24? But it could be uncertain simply because the world is an extremely uncertain place right now. It always is, but right now there just seems to be a lot more uncertainty with regards to growth.
The answer is in the middle, Neeraj. The defined 1-3-30 programs have milestones, have targets, have end dates. So that is very clearly monitored as to what the delivery is going to be. So there is no excuse away from that. In terms of realizing the opportunities, you're absolutely right? We are talking about, recession, is that going to impact and slow down and our ability to, to get orders and convert that into revenue? Those questions will always be there, and I can't sit here in judgment and say how the world will look in 6 months' time or 9 months' time. But leave that aside. Internally, we clearly have a plan saying that if this is a resource that we are putting in, what is the return expected from those resources and what they are going to deliver.
Sure. Just wondering though, because every company which is global in nature, the last 3 months would have gone out to clients, gone out to salespeople and tried and understand what could the larger impact be. And I've heard varied responses, and it's evident in the display of some of the companies global in nature. Thus far, it's largely been IT services global in nature which have come out, but some of the sound bites that have come from other companies as well. Companies exposed to healthcare, okay. Companies exposed to aviation, okay. Companies exposed to auto, okay. Companies exposed to BFSI, uncertain. So it's a chalk and cheese picture out there. Now, for you, largely, you would be spread across, but I'm still trying to understand. Are you worried about FY24, or are you a lot more confident because the nature of your clients might not be as badly impacted as some of the others?
I would summarize it by saying I'm cautiously optimistic.
Okay.
Right.
Not optimistically cautious.
No, I would say cautiously optimistic, right? Because I would like to, of course, have the head on, in the clouds, but also feet on the ground. Because the answer lies in different, lines of the P&L. So if you're talking about interest cost, we all know what the Fed hikes have been, in the last, 12 months and how it's going to pan out. So we had an interest rate management policy, which we, put in place only last year. We refreshed it, I would say, because we all lived in a benign interest rate environment, and were kind of that muscle, of managing that volatility was sleeping. We had to invoke that muscle and get it up back front and center, and therefore manage that, in a very dynamic environment. And that has nothing to do with revenue. I need to, manage that line, whatsoever. Coming to, revenue, I need to be prepared, because what if the opportunity is there? As much as you say that there is slowdown and there is cutback, equally, top managements and boardrooms do not want to cut costs from digital. There is FOMO, right? And if they cut costs, in digital, and will they be left behind because product life cycles are short, and people need to ride that, that bandwagon fast. So we are educating our customers also, and there are opportunities even in this situation that our products can deliver on the cost side of the equation, right? It is not just revenue outcomes if they are, saying, oh, that's uncertain, should I invest or not? But there are also cost side of the equation where there are enough opportunities. So I would like to believe that yes, the environment out there is volatile, but if as long as I have something which I can add value to my customers and I can go and table that in front of them, we have a good chance of converting that to revenue.
Okay, so last two questions on numbers before we then get to what you were, what you are, because that is where I'm actually wanting to ask you a lot more. Uh, on the interest costs, right? Q3 over Q2, Q4 over Q3, there has been a jump despite the fact that debt, I believe, has gone down. Now, do you reckon because the interest rates might stay higher for longer, even if they don't go higher from where they are right now, maybe there's a hike in May, we don't know, but post that people are presumably saying that there won't be a series of further hikes. My question to you is, do you reckon that interest costs for the whole of FY24 stay at these elevated levels, or could they come off just marginally?
Yeah. I mean, I'm not here to speculate, but what I would
You have
do,
some idea about the flows and about what you would
yeah.
do, right?
So what I would do, and my interest rate management policy and forex policy is very simple. It needs to provide certainty to near-term P&L, right?
Okay.
Which means when I walk into FY24 and I'm drawing out a scenario as to what is that I'm going to deliver as top line, as bottom line, and as EPS to my shareholders, I need to have a fair amount of certainty on each of the line items that contribute to it, and interest cost is a big element. So over the course of the last 12 months, what we've been doing is tactically taking in hedges for 25, $50 million, all along. Today, my weighted average, hedge that I have going into FY24 is in the money by a long run. And we have hedged about 55 to 60% of our debt. And the reason why I don't want to hedge the 100% is because I don't know if things come down one way. And second is I also want to have a headroom that if my business generates more cash and if I decide to, pay up debt, which is what we have done, right? I've never thought that we will get to 1.3x of net debt to EBITDA. This business was north of 2-3 years ago, right? So we've now come to 1.3x because we have kind of eliminated waste from the business, improved our EBITDA to cash conversion ratios, and therefore generated enough free cash flow. In fact, the last year's 2,539 crores that we declared as free cash flow is the highest ever that we have declared in this company. So all of that has gone towards funding both organic, inorganic, acquisition fees, plus also, reducing, debt considerably. So my interest burden has also, has come down. And I would like to keep that flexibility going forward as well, that I have that headroom that if there are no avenues that I see there to spend, then can I actually go and, and reduce debt. So I would say going into FY24, our interest cost is fairly under control with 60% already hedged and in the money.
Okay. So last question on the numbers, 9% YOI growth FY23 over FY22, if I'm not wrong, 10%, let's say. You reckon those numbers should be possible and at a better clip of growth on the bottom line?
Well, are you talking about FY24?
24.
Yeah. See, on FY24, I just came out of the earnings call with the analyst as well. And I've said that I will operate under the lower end of our 23 to 25 range, right?
And you also said that if you have to get business at the cost of margins, you will go ahead and do that too. I heard that comment.
Let me explain that. What do I mean by, because the same me said a year and a half ago that I'm not going to be irresponsible, that I'll throw margins away to get business. Let me explain. What do I mean irresponsible is you dropping the price and being stupid, and going and buying deals. That is unacceptable, and that is not something that we promote and encourage in the organization. But if I have to invest in the business today, and that investment doesn't have, doesn't have the fixed cost absorption because my top line is smaller. Like, for example, let's take, I win a great IoT deal, and I need to create a platform, and I need to create that analytics dashboard and engine. Now, I know that once I, create that, and it costs me $1 million to do that, I can replicate the same shell to 100 other customers. But for the first customer, I can't charge the full, I should still be able to charge only the variable cost of it, right? So what I look at is the unit economics. What I look at is the destination margin once it reaches that particular scale, which means that I am actually having a profitable, business model. Then it's a matter of time that I need to scale up and operating leverage will kick in and I'll get more margins. So what I'm trying to tell you now is that in FY24 and hopefully for the foreseeable future, that's our fit to grow model. Our fit to grow model is that we generate the top double-digit growth, we get the operating leverage, but take that money and invest it back into the business. And that's why we are saying we will operate in the low end of the range, because we are making the choice of taking that money from the business and investing it back. If I don't invest, I will be at 25.
Yeah. I'm sorry, but I'll have to ask one more question before we move to the nature of the business and how it's changed. I think the I wouldn't call it an issue, but for lack of a better word, the grouse that people might have is that there's a lot of promise in the kind of work that you guys are doing, the kind of work that you've already done, right? And how it should translate into growth for you because of the promise that the business holds. The grouse that people might have is that the numbers are not, while they're showing now and starting to show, as you said, double-digit revenue growth, 3 quarters, etc., they're not quite there based relative to the expectations that people might have. Therefore, my question that for how long does this phase of you reinvesting capital for future growth continue in a way that it doesn't propel your revenue and bottom line growth at a meaningful clip, at a better clip than what you have right now? Let me put it that way.
Neeraj, again, let's go back. What was this company, 10 years ago, 5 years ago? Yeah, we hadn't invested, in this business. We were getting single-digit growth rates. We had low profitability, single-digit ROCE. Right? That's the shape of the business that we were in. And of course, understandably, people were unhappy, and our share price was, trading at 200, 300, rupees. That fundamentally, both Lakshmi and I believe, is not the path to value creation. The path to value creation, we are in an infrastructure company, and we need to invest, capital. And we didn't say we will invest capital 3 years ago, because at that point in time, had we gone and said, we wouldn't have got the confidence of the street to back us. We have eliminated waste. We have improved our profitability from 17 to 25%. We have improved our ROCE from 8 to 28%. Right? We have reduced our net debt. We have delivered the highest ever PAT. We've got the highest ever free cash flow. We have got net worth positive for the last 9, 10 quarters. And all of that now should give you a confidence saying that, yes, this company has the muscle, and this management, has the muscle to go and, and dream and get this.
Yeah, most certainly. I'm sure people do that. People just wondering about when does the metamorphosis come in terms of the pace of growth from what it is right now. Surely you improve from what it was. No questions on that.
And I spoke to you last quarter, right? There could be 1 or 2 transformative deals, that could happen. That could be the inflection point.
Sure. Okay.
And when you cook those deals, though it takes time. Yeah, this is not a consumer play that I've got it and put on the shelf and do a good bit of marketing and people can rush to the to the shelf and pick it up. You have to work with your customers. You have to give them the confidence, and a lot of them are big level enterprise risks that they're going to take with you.
Yes.
Right? So they will go through their own due diligence before putting eggs in your basket.
Most certainly. Okay. Now tell us, you guys are doing a lot of work, right? And there are newer avenues. We got a good lowdown about the media side of the business as well. And on the call as well, you spoke fairly well about the kind of growth that is coming up. But tell us about the Tata Communications now versus what it was. And think as talking to a layman and try and tell me what is it that FY24 holds in store across various line items for you.
Yeah. Look, I mean, aside the financial parameters that I explained, which I'll not repeat, in the interest of time. We had the heritage or the DNA of a carrier's carrier. Right? We were a wholesale player. That's where we came from. See, our genesis with BSNL, acquisition by Tata's, and thereafter, has been that play for us. What we are trying to become is a Comtech player. So we do not want. It's not that I don't like telecom, but we would like to take that strength and then be a Comtech player. So which means I'm going to use my underlay as my asset base and then offer value-added services, on top of that. Connectivity, whether you like it or not, is going to be the enabler for a lot of things. All the cars in the world are going to be connected cars. They are all going to run on softwares and and operating systems, and which need upgrades, right? Which needs constant connection. And when we talk to OEMs, they are saying, I want an always connected 24/7 car. right? That I would like to access. And that is what is going to probably happen, not just for automotive, but it's also probably going to happen for everything, which has the potential to change the business model from owning an asset to owning a service or delivering a service, right? Or consuming a service, and which is going to be completely enabled by connectivity. If I just take that as an example, and therefore we would like to invest in familiarizing ourselves with the industry vocabulary and industry use cases and industry value addition that we can do, so we can take our underlay and go and sell these value-added solutions, to our customers. That's why the Comtech player is important. That's why when Lakshmi called out that we want the shape of the business to be 50-50 from a digital, solutions portfolio and our core connectivity to be balanced. Today it's like whatever 68, 32 and 70, 30, 60, 40 we're getting to, in that range. But we would like to have it a more balanced, portfolio of 50-50. That is reflected in our order book. Yeah. That is reflected in the relevancy quotient that we have with our customers. The conversations that we are having are no longer give me a 10 gig pipe. The conversations that we are having is about us elevating, into the digital transformation stories, of the enterprise. So the flavor, is changing. And I've said this in multiple forums. There's a huge cultural transformation that we are going through in Tata Communications. Yeah. Because you've been used to a certain vocabulary, used to selling a certain products at a certain tenure to a certain, customer and a geography. Fundamentally shifting, away. I am no longer selling products. It's platforms, it's solutions. I'm no longer talking about cost, it's value. I am, a broad-based player who's there to offer multiple suite of services for you, right? And I can, wrap them up as a service offering and, and give you an end-to-end solution and a one throat to choke. And I'm, talking about what are the customer drivers and how I can enable this borderless growth, how I can bring agility into your systems, how I can drive cost efficiency for you, how I can minimize risks for you. So I'm talking the same lexicon which is there in customer boardrooms. I'm therefore super confident that we will get there. And any cultural transformation takes time. We've started off with the financial transformation. And why the financial transformation was important? Because all other legs of transformation, whether it is product, whether it's go-to-market, whether it's people, all of those need funding.
Sure.
And that's why the financial transformation had to be ahead of the curve. And I'm glad that we have now reached there, and we will continue to, keep the momentum up. So those are now being funded, and so we can really culturally transform this organization.
Okay, well, we wish you all the best for that, for sure. Last two questions. One, within the various legs or various verticals that you are working in, or various structures that you have within this one umbrella, where is it that you are the most optimistic about growth coming in and staying higher for longer?
Yeah, I would say in the digital platforms, and solutions portfolio, Neeraj, there is move. We are very, very excited about it. The IoT business, super excited about that. Media business, we went and acquired Switch, in the US. That is really, really, inspiring for us, because you are naturally able to elevate the conversation from providing a pipe to really providing, high speed, low latency network for Formula One, consumers, across the world. And this is like global to global audience, and we are moving from, regional to global audience, and then regional to regional, play as well. So we are really have a place to, to expand there in media. Another thing which is taking up is security. The entire SASE play, the zero trust environment that we're talking about. So these are all, and then we have, multi, cloud. We have the cloud SIM that we have just, recently launched in MWC as our new product and offering. All of this are, for me, the S curves of this company. And each of them, I would say, has a potential of 500, 700, $1 billion in the next 5 to 7 years. And they need to be incubated, and they need to be provided that tender love and care, at this stage, so that they can really get on their feet and start delivering the value for us. When will that inflection point be? I don't know, 12 months, 18 months, 24 months, but I think we are quite positive about all of them.
Yeah, you yourself mentioned, I think last quarter as well, that you are in conversations on multiple fronts, on multiple verticals. When the timing happens, doesn't happen, but it could happen very, very soon as well. But you are trying to do across all of these.
Across all of this, and I would say, while whatever happens in the field will happen, we are making progress internally.
Sure.
That we are enhancing these product capabilities, and our 1330 is cutting across all of these capabilities as well. So we are quite pleased with that progress.
Okay. Last question. Any one-offs, any asset sales, anything else that you that might happen that the street should be watching out for in FY24?
See, everything is declared in our results. I mean, there is this AGR liability that is there, which has been the bane of all telecom companies. We've also put that together. We are in discussions, with DOT to bring clarity, into the entire thing. So that's there. So plus we also have, assets of real estate as well. So all of them are out in the open. So I believe in transparency, and I believe in absolute clarity. So there's nothing that I do not know of. That
no, what I'm saying is you're not timelining these things.
I don't know, because as to when these will fructify. But I am in all our scenario plannings, we prepare the organization that if this were to come now, how are we going to actually manage that? I mean, that is our core job.
Great. Well, we wish you all the best for an exciting journey ahead, and hopefully the journey is even better than this lovely experience center that you guys have put out here.
Yeah. Thank you very much. Thanks for coming over.
Thanks for talking to us today.
Yeah.
And viewers, thanks for tuning into this earnings conversation with Tata Communications.